Hi, I'm Jim, and welcome to the channel, where we help you make the most of financial markets to grow your money sustainably. Today we're going to be touching on a brief history of the markets, the difference between historic and more modern markets, and we'll also take a brief look at what financial markets might look like in the future. Origins of the markets. The stock market can trace its origins to medieval France, where brokers in the modern sense traded debt and crop futures from agricultural areas. Of course, brokers have existed from much further back in history, but generally trading physical commodities prior to this. The first stock market, however, was created by the Dutch East India Trading Company in 17th century Amsterdam, established with the sole purpose of providing a vehicle to trade stock in the company. It was a simpler form, but not that different from modern markets, really. The idea was to create a public market for both institutional and private investors to buy shares. This, at the time unprecedented access level, meant that they could raise money to finance ventures to interested parties without directly approaching them, making it far easier and less time-intensive to obtain investment. In return, it allowed exposure to potentially profitable trade ventures and therefore a return in the form of a profit share for those that bought the shares, in the same way that you may be paid a dividend for owning shares in a public company today. They could also then trade the shares they had bought as the company continued to grow and gain value. The Amsterdam Exchange remained trading like this for close to 100 years before exchanges in other major cities followed suit, creating the core of the modern finance network that we see today. Why do they exist? Primarily, publicly traded stocks are not really that different to how they were in the 17th century. They're a vehicle allowing investors to purchase a portion of a company, allowing the company to invest that capital in return for a potential profit share. These days, these tend to come in the form of dividends. This easy access to capital makes it much simpler for publicly traded companies to obtain capital required for development. Although it's important to note what companies are spending capital on, whether gains through a private placing or simply through outstanding share sales. If a company isn't using fresh capital to fund development and simply using it to finance debt or similar functions, it might be an early warning sign that a company is not performing and therefore unlikely to generate enough free cash flow to provide a return to us, the investors. After all, that's what we're here for. That said, it's not just stock purchases that can provide exposure to potentially profitable opportunities. Modern markets have a large number of products and instruments tradable, as opposed to just equity purchases in the past, and this is really the big difference between today's markets and historic markets. You can trade via lots of products, including traditional equities, derivatives such as CFDs, options and futures, or even participate in initial public offerings, or IPOs, or private placings should they be suitable. You could also use credit swaps, debt financing, commodity trading, and many, many more. Don't worry, I'll cover all of these in more detail in another video. It's also worth remembering that the pace of modern markets is much faster than historically. In the past, you would have had to call or even visit your broker in person to arrange a trade, whereas these days you can trade at the touch of a button or even automatically based on limit orders or algorithmic trading software. What might we expect in the future? Well, no one has a crystal ball. We can't see the future. If you can, please share your favourite stock from 2030 in the comments. And with the rise of robo-advisors, automatic trading programs that make buys and sells based on technical indicators, you'd be forgiven for thinking that in future, all investing may be done via algorithms based on these technical indicators. Don't worry, I'll cover these in another video too. But it's worth noting that overall returns tend to be significantly better through other forms of management, discretionary or advisory for example. And don't worry, I'll also cover this in another video. Simply put, robo-advisors cannot take human input into account, and companies are run by humans. Well, mostly at least. These also cannot take into account the fact that the market's best buys and sells are often driven by irrational overreactions to news flow, causing either inflated or undervalued companies, which we can take advantage of should we be able to remain agile and deploy capital carefully. I hope you enjoyed the video and it gave you some insight into the purposes and development of our modern financial systems. If you did find this helpful, please do drop us a like and subscribe to the channel. It really does help a lot to spread the word so we can help more people.